Hello, welcome to Dreamish Global Academy. And today I'll be talking about forex trading, mostly for beginners, people who have little to zero knowledge of forex trading. Um, One thing you should know about forex trading is very, very difficult and it is also easy. It is difficult in the sense that it exploits your psychology, right? That is what makes forex trading very difficult. It exploits your psychology, your emotions, and that is why you hear a lot of people say forex is not for the weak. And that is because, you know, when you start trading, you discover that it is not easy to manage your psychology and your emotions. And why some traders try to make it look like it's easy. I will tell you for the fact that to analyze the charts is very, very easy. To be constantly profitable as well. I wouldn't say it's easy, but it boils down to how you can manage your emotions and how you can manage your psychology. That's just what makes forex trading difficult. Aside that, I do tell people that you can learn to analyze in just 3 days in a week because analysis is just the minute part of trading, right? Out of let's say 100%, I can say analysis is just what makes you profitable 20%. The remaining 80% boils down to you as the trader. And that is why when you keep on going deep into forex trading, you would start to discover a lot about yourself, and you know for sure that everything boils down to you as a trader. Now, I'll just take a run through on analysis. I'll just give a you know brief introduction on analysis. Now, as a trader, first of all, let's take aside the psychology part of it. Why analysis is very important is because you need to be able to know how to predict the markets. And as well, you need to be able to, you know, because Forex is probability, right? And um there's a high tendency of you predicting the markets correctly and also still predicting the markets correctly over time, right? But there are cases whereby yes, you might predict the markets correctly and still yet market goes against you, and that is why we always say that always expect losses, right? It's not, since it's a game of probability, it means that there's a probability as well that even when you have everything right, every criteria met, you still have, you still hit a loss, which is perfectly normal. Now, why analysis is also an integral part of trading is because we deal with predictions, right? We do with predictions, or the market is going to buy, or the market is, going to sell. And if you don't even know how to analyze, then definitely you won't even know where to project the market to, or what you should even be looking out for on the chart, right? Now, there are so many pairs in the forex market, so many pairs, so many instruments that you can trade. Some people trade cryptocurrencies, some trade forex markets, which is the currency market. Some trade commodity, which is gold, and there are so many assets that you can trade when it comes to the financial markets. But you need to have a niche. You need to have a specific pairs that you say, oh, this is what I want to trade, right? Because in as much as there's so many instruments and so many assets to trade, you can just go out there and just be trading anything that comes your way. For me, I started trading with deriv, which is volatility pairs. Then I moved to currency pair because I needed to, scale up, then also have access to both fame and larger capital because the bigger your capital, the more the more possibility of you making more money out of the markets. So now going to analysis, you could see that we have what we call the time frames here. By the left hand side, you see 5 minutes, 15 minutes, 30 minutes, 1 hour, 2 hours, and so forth down to a month. Now, all this time frame, they have specific uses, right? They have specific uses in the sense that they are not just there for fancy, right? I've always advocated that when you want to analyze, you need to go to the higher time frame to see to see the market from a wider view, right? From a wider view. Now, it is more like you going to look at the market from a 1 month or a 1 year view to know, okay, for a month or for this year, should I be looking out for a long-term buy in the market? That is for a whole 1 year. So when you have a projection of the market maybe for a year, it gives you an insight that in the long run, yes, there's going to be sales, right? Because it is buying and selling that makes the market a complete equilibrium. You can't just have a buying market without having the selling part of it. And that is why market always moves in sequence. So something like this, a buy, a sell, a buy, a sell, a buy, a sell. If there's only just one entity in the markets, it means that if there's just only buyers, it means that market is not going to be in a sequence, meaning market will either be in just a linear or a straight line, something like, just all the way up. But because we have two factors that determine market movements, we have the buyers and we have the sellers. So the sellers would always push price low or to balance the movements of the buyers. So like something like this, we have from here, we have a very strong buy here, and you could see that the seller had to push price all the way down. We have these movements and we are currently here, right? Now I'm on the 8 hours time frame. Now, if I'm trading with that is why the higher time frames are not meant for looking for opportunities, you know, they're only meant to give you a broader view of the markets. So, um, some traders could just use the daily, which is fine. Some traders could start from the weekly, which is also fine. While some still go to the monthly, and which is also fine. It depends on how you want to see the markets. Now, there is a difference between structure there's a difference between a trend and there's a difference between candles. What you see here are candles, and that is why it is the candles that gives you the interaction between the buyers and the sellers. What are the buyers doing, or what are the sellers doing, or who is having more control in the markets? This is what the it is what the candle tells you. So you can actually interpret what the candle is saying. For every time frame, you can interpret what the candle is saying. Now, I'm on the monthly time frame, and when you go to the monthly, you can see we have structures. Now, structures are what gives us a headway or a heads up where the market is likely to be heading to, right? So we have structures like this. We have a high, we have a low, we have a low, we have a high, we have a low, we have a high, equal high now. So now we have equal highs. We have another low. This is a high as well. Now, structures helps you to know where the market is heading to in the long run. And in a case like this, we can see in a case like this, we can see that um the structures here is telling us that in the long run, market has been pushing to the downside, right? And like I said, that there is always a balance to every move. Once you see a move to the upside, there will be a balance to the downside as well. But looking at it from this point, now how structure works is that when you have a downtrend like this, a high, you have a low, what validates a downtrend is that the high, the previous high, is not meant to be broken. It is more like a law or a principle of market structure. So meaning that if I have this low and I have this high and markets sells all the way down, it is not meant to break the last candle of that structure. Price is not meant to take it out. So prices will always respect the high and the low. Now, for a buy structure, we are going to have, so let me look for a pair that has a buy structure. So we have this as a buy structure, we have this as a buy structure. Now when we look at this, we can see that we have a high. We've been having series of highs and lows from this structure. We've had a high, we have a low, we have a high. Basically on this pair, we have a ranging market. Now a ranging market is a market that is not giving you higher highs and lower lows. They are giving you equal high, equal low. Like this, we have high here, we have a low here. Our market both could not still break this high. We have another high again, still in the same level. We had another low again, still in the same level, right? And now we had another high again, still around with the same zone. Though we can see that this market tried to break out completely from this zone, and we had a very strong push to the downside. So this is still a typical example of a bullish market. And if we go to the weekly, we can see we have something like on the weekly, you see the trend. So now we have something like this, a low, a high, a low, a high, low, high, low, high, low, high, low. So this is a typical example of a bullish market. Now let's go back to the GBP USD. So this is GBP USD, Great Britain, British pounds versus the US dollar. Now, when we go to the weekly time frame, the weekly time frame helps you break the monthly structure into weeks, just the way we have 4 weeks in a month, right? Then when you go to the day, we have 7 days in a week. So the more you keep on going lower is the more um you keep on seeing the structures in a lower time frames. Now, what you should know about the lower time frame is that the lower time frame helps you to see the initial movement of the market. So it means that when you go to the lower time frame, like for example the 15 minutes time frame, a 15 minutes time frame would give you a breakdown of what is making the let's say the 4 hours time frame to be on a bearish trend. I don't know if you are going to understand this perfectly, but with time you would understand what I'm saying. So we have uh the monthly time frame, which I said we don't use these time frames to take trades. We only use this time frame to just um know where the market is likely to head to, let's say for months, right? And same thing with the weekly. We also use it to know where the market is heading for, weeks or still for months, right? Now, like I said, that when we go to the lower time frame, if we are having a bullish trend, or if we have a new trend that is about to start, or we have a trend that is about to end, you get to know on the lower time frames. The lower time frames helps you to see when a trend is about to change. Now, like I said, that every time frame has its structures. Every time frame has the structures, and you should also know which structure is for which time frame. If I go to the daily has a structure for the daily. If I go to the weekly has a structure for the weekly. And if you go to the monthly also has structures for the month. Now, you don't use another structure, another time frame for um let's say you don't misplace another time frame structure for another time frame. Now, this is what I mean. When you are in the 5 minutes time frame, you need to look out for the 5 minute structure. You need to look out for the 5 minute structure. Now, the 5 minute structure is the closest structure you would see, meaning that we have now you can see that uh we have a low here. Now this is meant to be here. So we have this. This is the low and this is the high. Now we can see that price has been trying to break out from this low and has not been able to break out from this low. See that price has been trying to break out from this low, but has not been able to break out from this low. And like I said, that the highs, when you are in a bearish market, the highs are always respected, meaning that the markets, once market breaks a low, it is not meant to break a high, right? I don't know if I'm already going too fast, but I'll just have to slow down. Now, let's go back to time frames. Like I said, that a time frame would always tell you um what the market is doing in a particular time frame, right? Now, this does not simply means that the market would only buy or sell in that time frame. Now, we are looking at structures, remember, we're looking at structures. And I said structures gives you the direction of where the market is likely heading to. And the structures, which are the highs and the lows, are what helps us know, oh, if a market keeps on breaking a low, it's signaling to you that this market is on a bearish move. Like we have a low here, we have a high, and price came and still broke this low. It's already giving us a message that, oh, uh, I intend going lower than this. And you can see that from here, price still broke this low. After price pull back, and this high was not taken out, we still had price coming to break this low. So still signaling to us that, oh, I still have more plans on going lower. And you could see that whenever price pull back, it still comes to break each of these lows, right? So now going to the 5 minutes. Now, how do we know that price is no longer going to continue breaking a low, right? Now, that is where we have the lower time frame. And same thing too applies when it is in the opposite direction, let's say for a buy. Now, let's go to USD card. Now, you should know that the USD card and the GBP USD are opposite pairs, meaning that if one is buying, the other will be selling. That's what it simply means. If one is buying, the other will be selling. Now, let's take a look at the USD card. You can see that the USD card has a um a bullish trend from the lower time frame, in the sense that we have this structure. So we had price taking the structure. Like I said, at the moment price breaks a structure, a protected high or low is giving you a potential change of character. So now you could see that from the 5 minute price broke out from this low, meaning that this high was not meant to be broken. So this high was not meant to be broken according to the law of market structure. Once a low is broken, the high is meant to be protected. Now, the moment price took out this high, you could see that took out the high, came out and retest where it broke out from that high and started buying all the way up. Now, if we want to have a change of direction, it is called a change of direction. If we want to have that same change of direction, we also have to see something like that here. So now we can see that this high was taken out. Once this high is taken out, it simply means that what this low is meant to be protected. But if for whatever reason price comes and you know significantly take out this low because this is a low, right? This is a high. If price significantly takes out this low, it will definitely what it will call we expect price, not definitely, we expect price to also come back to retest the um the broken the broken protected high or low. Now, when we look at this, we can see that the moment price broke out from this high, it came back to retest and start buying. But it doesn't happen in every instance. It doesn't mean that whenever price breaks out from a low or from a high, it will surely come out to retest. Sometimes price breaks out, it doesn't even retest, or it comes very close to it and very close to it. Sometimes it doesn't retest, just come very close to it and starts going to the direction in which it wants to go. And some other time, markets it might not even retest here. It might still pull back deep into this zone and starts buying or selling. Now we also have, I'm not meant to bring this yet. So we also have this in which price can decide to break out, comes to this level to retest, and we have we have price going right into its direction. And some other time you might not even have a retest. You might just have price breaking out with speed and just keeps on going without having a retest. So back to analysis. So like I said that the structures helps um gives us a hint of where the market is likely to be heading to. And as simple as this is, it sounds so simple that, oh, if this is just how it is, then why are people not really making money in the forex markets? Now, that's why I said initially before when I started this class, I said it is the psychology part of the forex trading that makes it very, very difficult. Now, I use the word very, very because as at yesterday, when I had one of my biggest loss so far, after I had a very big win, I had a massive loss as well, in the sense that look at these accounts. This is a $15,000 account, pop fame account, and my biggest win so far has been 470, and you know, have series of losses, have wins. And the moment I made this big profits, these huge profits, I lost everything down immediately. So it's not easy to trade the forex markets. I will tell you practically how it is, you know, but it's a game of psychology. It's a game that you need to know how to manage yourself. That is just basically the truth. The problem is not from the market. The challenge is not from the market. The challenge is from you as a trader. From you as a trader. Once you can, manage yourself as a trader, then it will be easy for you to trade the forex markets. Now, if you don't know how to keep to your routine, you don't know how to keep to your words, all these things are going to have a lot of impact in your trading career because forex trading it comes down to who you are as a person. It comes down to who you are. If you say you're going to do something, always make sure you do it. If you say you're not going to do something, always make sure you don't do it. But the moment you start breaking those rules, then everything falls apart. Now, for this trade, we can see that you must know how to combine the higher time frame with the lower time frame. Now, this is where it becomes very, very technical. And I think I would have to end this session at this point because it is one step at a time. First of all, I've even gone too deep into the video. My next session, I'm going to take out time to talk about structures because everything in analysis boils down to structure. Everything in analysis boils down to structure. When you understand structure properly, you could understand market movements and market reaction. But once you don't understand structures, then every other thing is going to be very difficult to understand, right? All right. So thank you for taking our time to listen to this. We'll meet again in the next session.